Good evening, friends. This side Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting, and also a venture capitalist. Standing today on 27 September 2019, practically 3 a.m. in the morning, we're going to be shooting a pretty important video about the risk-free reference rate. While we have a committee which is Alternative Risk Reference Rate Committee ARRC, and the duty of the committee is to decide that what reference is going to be taking in future as LIBOR is phasing out. It is not an easy decision, we agree that, because multiple reports suggest multiple numbers, but we need to appreciate that the LIBOR is over $1,000 trillion worth of derivative. And the recent BAI Standard survey, unfortunately not getting a detailed rate structure, but is saying that even if we assume that on a yearly note, we do 272 days of trading, then the IRS interest rate swap market is over 1770, which is 1.77 tera trillion market. 1.77 tera trillion market. This is a pretty big market we have. Why the original I would also the decision, the original consensus was to go with SOFR, which is secured overnight financing rate. But I don't want it to demean any country, neither I wanted to offend any country, but the reality is that today the cake, the IRS cake, interest rate swap cake, is actually supposed to be divided into the 5 parts. There are 5 candidates now, and the biggest problem of these 5 candidates is on the fallback language. I know in both the degrees, which is the CFA, Certified Financial Analyst, not Chartered Financial Analyst, Certified Financial Analyst, and FRM, Faltu Risk Management, they are not teaching but is fallback language. There are actually 2 languages which we used. We have more than that. 2 important languages are the fallback language, and another is the derivative disruption language. So derivative disruption language is a completely different. It's just like you talk about Mr. Will Smith, who is a well-known actor in Hollywood and I think one of the highest paid Hollywood actors across the globe, and one of the highest paid celebrities of the globe. While if you talk about Shah Rukh Khan, who might not be the amongst highest paid celebrities in the globe, but if you consider his movie business, but a well-known celebrity in the globe, right? So Shah Rukh Khan is the derivative disruption language, while Will Smith is nothing but the fallback language. We're going to have a separate video on the fallback language, but in short, fallback language is the very important language which we need to learn. It is not a coding language. It is not C, C++, Java, Oracle, something like that. It is a language which has to be embedded in a contract while signing between 2 parties. So example, say Temasek. In Singaporean language we call this Temasek. So Temasek is signing 10-year swap line with DBS. Example. And in this swap line is the TRS, which is total return swap. Take a simple example. Now in this total return swap, which Temasek is signing with basically DB, and we're going to have a separate video on that, which is known as private equity swap lines. I don't know how many books teach this private equity swap lines, but I'm telling you in advance. So what happens is that these are not very rare, but now coming often. The private equity invest their money in companies, and they expect revenue to come out of it. Now when the revenue will come out of it, the revenue come in a different currency while they are lending, while they are borrowing stream into the different currency. So for a minute assume that the Temasek revenue stream, the cost is in Singapore dollar while revenue is coming in the US dollars for a minute, and the liability of DBS is in US dollars while the revenue is coming out of Sing dollars. Sorry, the revenue is in US dollars, and let me repeat again. For Temasek, the sovereign wealth fund, the income coming in US dollars while the liability is in Singapore dollar. For DBS it is reverse. So both DBS and Temasek enter into an agreement which is known as private equity swap deals. I don't know you heard this or not. I don't know whether you know how it actually works. We can have a separate video in that regards. Now when the money started flowing, now it's linked on USD, basically USD Sing dollar, it is linked on USD LIBOR rate for a minute, let's assume, or USD or SOAR, which is Singapore overnight average rate. All of a sudden LIBOR falls, and because of this reason there is an impact on SOAR. So the fallback language suggests that in such eventuality SOAR can be replaced with what rate? That has to be written, and it's not one rate that has to be written, it is more than 2 and 3 rate that has to be written. So basically, and it has to be quantified, very difficult. Fallback language is not a coding language. It is not C, C++, Java, Oracle and whatnot. It is a language which is used when basically the index or the benchmark on which the competition is happening could be quantitative, could be mark to market, L1, L2, L3, whatever. This benchmark is either replaced or turned obsolete or crashed. Either replaced, turned obsolete or crash. In all these cases, we end up having an adjustment which is known as benchmark replacement adjustment, BRA. Benchmark replacement adjustment. This is known as benchmark replacement adjustment. Now, in this regards, basically in this regards, which we had a fallback language. Fallback language sitting today should have 5 rates. Unfortunately, supposed to have 1, which is SOFR, but now we have 5. We cannot run away. One is the SOFR, secured overnight financing rate, and we should appreciate that CME, Chicago Mercantile Exchange, is a leading, much ahead in SOFR than anyone, much ahead. Then we have Sonia. Sonia is the name of the girl. Sterling overnight index average. Actually, it's between Sonia and SOFR. And unfortunately, SOFR is having a tad higher, basically heads up than Sonia. Then we have Saron. Saron means Swiss average rate overnight. Then we have ONIA, Australian overnight index average. Then we have CORA, CORRA, Canadian Central Bank benchmark price. Then we have CDOR, Canadian dollar offered rate. So currently we have 5 and one have 2. So in short 5, where in this cake would be divided. One is the SOFR, secured overnight financing rate, Sonia. As Saron, which is Swiss average rate overnight. ONIA, Australia overnight index average. CORA, Canadian Central Bank benchmark. CDOR, Canadian dollar, CDOR, Canadian dollar offered rate. Now the question is that ISDA is doing change in the 2006 Master Service Agreement. I don't know when this change would be coming. The reason being that after 2021 LIBOR cannot be quoted. That is also a fact. So ISDA left with practically 1.5 years to complete this case. So when ISDA come up with a change in ISDA 2006 Master Service Agreement compared to the follow-up language, then it ends up having 3 questions. And I hope that ISDA will answer these 3 questions. Number 1, what would be the fallback trigger event? I don't know. I really do not know. The reason is we can have 1000 fallback trigger event. But it is there. Benchmark replacement. Which benchmark to replace? I have 5. SOFR, Sonia, Saron, ONIA, CORA, CDOR, and one more is coming, which is European short-term rate, ISDA. Now what to do? One more is coming, ISDA. This cake has to be divided amongst many participants, but media is not talking about that. Don't worry. Then we have benchmark replacement adjustment. It is at least twice quantitative than we have XVA. Who will compute this? Do we have a standard quantitative methodology written anywhere wherein we can compute the benchmark replacement adjustment, shortly known as BPA? Do we have any written text, any quantitative material, any quantitative method which is written and say Regulator like Monetary Authority of Singapore is in sync of that. I don't know. Fallback language and derivative disruption language are very important languages we have in ISDA. While fallback language basically focuses on the benchmark, as for the European benchmark regulation is completely covered under fallback language. We're going to talk more about in our upcoming video. While derivative disruption language happens used in case in the eventuality like I would say Bear Stearns, Lehman Brothers, and all these companies who turned bankrupt in one night. Basically interbank binding in short. Derivative disruption is used in interbank binding. It could be L1, L2, L3, I don't know. The moral of the story is that 2021, we already told to many people, 2021 LIBOR transition is not possible. ISDA governing body is not ready with the fallback language. Even if they are ready for a minute on paper, the derivative disruption language, they are not ready. And last but not the least, the benchmark pricing adjustment, BPA, which is a complete quantitative exercise, they are not ready. And that is why I said the next 2 years is going to be pretty interesting year when we need to wait and watch how the things would be moving. That's it. With this, we thank you very much. Have a great time. You know my mobile number, +91 9899242978. You know our fixed income platform, www.fixedincome.global. Have a great time.